Lights, camera, and
You're good to go.
okay. Kenny, Jim Slavin, pleasure to meet you.
Pleasure to meet you, man.
You Kira?
Yep.
Very nice to meet you. Listen, thank you so much for your time this evening. Incidentally, what is it that Ted said that caused us to get together tonight, Kenny?
He says he's working in the area of money and how you can help me earn more of it.
Okay, all right. You know, Kira, what do you do for a living? What do you work at?
I'm a full-time student.
You're a full-time student?
Mhm.
What do you study?
Psychology with a business minor.
Wow, how far along are you in school?
This time next year I'll be done.
Getting excited about graduation?
A little bit.
All right, all right. Kenny, what do you do right now?
I am a free man.
You're a free man?
Yeah, and I was actually an assistant manager at Burger King.
Uh-huh.
And they had to cut down on people, so
Okay.
I was one of the people they cut.
All right.
Not literally, but.
Okay.
Yeah.
Wow. How long were you at Burger King?
7 years.
7 years?
Yeah, 7
What kept you there so long?
Honestly, I was just going through life, just looking for another opportunity to do something, and nothing came along, so I just kept going.
All right, fair enough. Well, listen, guys, again, thank you for your time. Ted and I don't have a lot of time tonight, but we're here actually for just two reasons. Primary reason, as Ted mentioned to you, Kenny, we're in the process of expanding, so we're looking for people both full-time as well as part-time at Akira. So you may be open. I know you're a student right now, Akira, and Kenny, you're probably between jobs. You're probably looking for something right now. So there may be an opportunity in this for you as far as making some money, maybe part-time, maybe you transition to a full-time. But the second reason is, Kenny, all we do is we help people with their finances. We help people with money. So when you see what we do tonight, Akira, you may be, find that we can help you both out personally. And if that's the case, we can talk about that during the presentation. Is that fair enough?
Fair enough.
Okay. Now, Kenny, have you ever heard of Primerica before?
No, I'm not.
How about you, Akira? Have you ever heard of Primerica?
No, not heard of it.
Okay. Well, Primerica is simply just a big marketing company. There's a lot of different companies, Akira, that Primerica is associated with. Like, for instance, we're in the Philadelphia area. So the Philadelphia Eagles, Kenny, as you know, play at Lincoln Financial Field.
Yes, I do.
Okay, I'm a big Eagles fan, so I know it's definitely, you guys aren't Cowboys fans, right?
49ers.
49ers fans.
Follow.
Okay, we'll see. We'll see about that. But of course, Lincoln is one of the companies that we have partnered with. A lot of people have heard of, like, MetLife, maybe Voya. Used to be Voya does a lot of 401k business. Used to be ING. Very big, Kenny, involved in mutual funds. Companies like Franklin Templeton, Legg Mason. You maybe heard Akira, something like long-term health care. Genworth and John Hancock, two companies. Auto insurance. You all drive a car, I'm sure, correct?
Mhm.
Did you ever hear of a company by the name of Progressive? Like, you see the commercials, you
Yeah,
Flow on
yeah,
TV.
Lizard and-
Little Lizard, the Geico. That's exactly right. Well, Answer Financial is a brokerage house, Akira, that we've partnered with. And Answer Financial, they actually work directly with some of these companies, Progressive and Geico and 21st Century and Safeco, companies like that. So we help people auto and home. Kenny, you know anybody in debt right now?
A lot of people in debt.
A lot of people in debt. Fact is, 8 out of 10 people here in this country have got credit card debt, and 9 out of 10 homeowners in the country have mortgages on their house. So there's a company we work with, Freedom Financial Network, in conjunction with Equifax. You've probably heard of Equifax, one of the 3 big credit reporting companies in the entire country, help people eliminate debt. We're very involved in life insurance, so we do a lot of things, Kenny, okay? Now, our mission, Akira, is to help families become properly protected, debt-free, financially independent, okay? Kenny, how we do what we do is we teach people how money works so they can make informed decisions about how to manage their finances. We provide what they call Akira financial needs analysis, which just gives a person a snapshot of where they stand financially. And then we also offer a variety of products or services that are designed specifically to help you people get properly protected, debt-free, and financially independent, okay? Now, let me show you the reasons why we're growing so quickly. Here's what's happening, Akira, in this country right now. Half of the United States has less than $500 in savings. Is that amazing?
It's crazy.
Look at 1/3, 31% to be exact, of America has no retirement at all. Okay? Half the country who are workers, like 401ks and 403bs, retirement plans, half the country is less than $25,000 for savings. 95 million households have no life insurance. Average credit card debt in this country, Kenny, is $16,000 and rising. 2/3 of the country, Akira, are living from paycheck to paycheck. Now, would you both consider these major problems?
Yes.
What do you think, Akira, is the number one reason why people struggle financially?
I don't know how money works.
That's exactly right. Let me show you what I mean, Kenny. When a person is young, as a child, and they're taught to save money, where are people taught to put the money? In a what?
In the bank.
In a bank. Akira, do you know what banks are paying you interest-wise right now?
Like less than one?
Less than 1%. So here's, Kenny, how it works. You take your money, you put it in the bank. The bank pays you, just like you said, Akira, less than 1%.
Mhm.
Let's say it's 1%, give them the benefit of the doubt. The bank takes your money, they put it in the economy. The bank gets a high rate of return. The bank gives you a low rate of return. Kenny, the bank gets rich at your expense. Here's what we teach, Akira. You take your money, you put it in the economy, you get a high rate of return, rather than letting the banks take it from you. Now, guys, there's two reasons people don't do that. One is they don't know how. That's what we teach. We teach people how to. But the second problem here is most people don't have any money to save because they're living from paycheck to paycheck at dead-end jobs. Does that make sense?
Makes sense.
Okay. Picture's worth 1,000 words. Look at this. You take a person, Akira, who is 30 years old. You both look very young, so it looks like you're well ahead of the game. This is a person who's 30, okay? Akira, they start putting away $200 away a month. They do that and they put their money away at 3%. They save, Kenny, from age 30 to 67, $200 a month and make 3%. You've got $162,000 accumulated at retirement.
Okay.
Akira, 6%, $200 a month, $327,000. 9%, $714,000. Is that amazing?
It's amazing.
Yeah.
Can you see why Ted's so excited about getting involved with us?
I'm excited, Ted.
Here's the challenge, Kenny. Most people don't have the $200 a month. Let me ask you a question. If I could show you how to earn $1,000 a month, maybe $300 a week, about $1,000 a month, would there be any reason you couldn't take 200 of that and put it towards your future financially?
No.
This is too, Kier, what if you put away $500 a month? What if you put away $800 a month? Adds up pretty quickly, doesn't it?
Mm-hmm.
Let me show you how all this works. Have either one of you ever heard before something called the Rule of 72? Have you ever heard that before?
No.
Okay. Rule of 72 is an old banker's principle, and this is actually what put me into this business 24 years ago. Here's what it means, Kenny. You take the interest rate you're making on your money, divide it into the number 72. The answer is going to tell you, Akira, how many years it takes for your money to double or compound. So if you put $10,000 away, okay, let's say the bank's paying you, Akira, 3%. Well, 3 goes into 72 24 times, your $10,000 doubles to $20,000, but it takes 24 years to double.
Right.
And then 24 years after that, Akira, you've got $40,000. Now, question. How comfortable, Akira, would you be with $40,000 in your retirement account?
Not comfortable.
Not very at all?
No.
Not very comfortable at all? Actually, about 2 weeks probably, right?
Yeah.
Okay.
Maybe one.
Now, who's the better one in math between the two of you? Okay. Akira. All right, that's fine. That's fine. Now, Akira, watch. If you took this 3% and you doubled your interest rate to 6%, you took the same $10,000. You're not putting any new money, just change where you put it. Instead of putting it in account A, you put it in account B. So if you doubled your interest rate from 3 to 6, same $10,000, 3%, your $10,000 grows to 40. You doubled your interest rate to 6, $10,000. What Akira do you have here, if you had to guess?
80.
Most,
80,000.
Ken, would you agree? Most
Oh,
people say
yeah.
80? Okay.
You doubled.
That's what I said. Because I figured, you know what? You doubled the interest rate, you must double the end result. It's actually $160,000.
Wow.
Okay? Now, give you a chance to redeem yourself here, right? Now watch, Akira. If you took the 6% and you doubled it again to 12%, 3%, 10,000 grows to 40, 6%, 10,000 grows to 160, 12%, 10,000. This is a one-time investment. What do you have at 48 years down the road now, Akira?
Mm. I would maybe like 600,000.
About 600? What do you think, Ken?
About $1 million.
About $1 million? Look at this. $2.5 million. Is that amazing?
It's amazing.
Mm-hmm.
Yeah. Do you think banks want you to know this?
Probably not.
Didn't we just agree a little bit ago that banks are paying less than 1%?
Yeah.
Let's say they're paying 1%. That means, Akira, your money doubles every 72 years. If you're making 0.5%, your money doubles every 144 years. Do you see the importance of what it is that we're trying to do for people? Because, Akira, now what's happening, when you get good rates of return on your money, now you start creating what I call generational wealth. Because now, see this $2.5 million? Well, that doubles to $5 million, and then $10 million, and then $20 million, and then your great, great, great grandchildren are set financially because you had the courage to do things that other people aren't willing to do, like build a business and get disciplined. Does that make sense?
Makes sense.
Now, sometimes, Akira, people have money that they have put away. Things like 401k, maybe they retired, maybe they got an inheritance from someone who passed away, lottery winnings, whatever. This example, Kenny, a person has $50,000. And most people, we said earlier, Akira, they get a lump sum of money, they put it into the bank because that's what the normal thing to do for people is.
Mm-hmm.
Well, if you take a person who's 30 years old, Akira, and they take $50,000, 40 years later when they're 70, if they put the money in a bank and got 0.5%, the 50,000 grows to 61,000. But if they just got 3%, Akira, it's 165,000. That's $100,000 difference. Kenny, if they got 6% rate of return, it's $547,000. 9%? $1,080,000. Is that exciting?
Yes,
Yeah,
it is.
that's
Now-
exciting.
Here's the important part to remember.
Mhm.
There's only two things, Kenny, that can happen with people. They can be alive, or they can be dead. So we're helping people save for their future, for their retirement, which, by the way, retirement is not, Kenny, in age, it's in income. Because, Akira, if I just gave you, just because I like you laugh at my jokes, I give you a check for $500,000, and you put that away, and you made a 5% withdrawal from that 500,000, it's $25,000 a year. Not all the money in the world, but now you've got a $25,000 a year income. But now if you had $1 million and you put that away and you drew 5% from it, that's $50,000 a year, Kenny. So now you have money working for you instead of you working for money. Does that make sense?
Yeah,
sense.
that
Okay.
makes sense.
Let me start winding down here. Money, Akira, takes time to grow, kind of like seed in the ground. So, Kenny, while you're building your net worth, you first have to ensure your net worth. Because, Akira, what happens with sometimes, unfortunately, with people, is we get a good investment plan. Maybe they have a good 401k at their job, or 403b, or a Roth IRA, or traditional IRA, or any kind of retirement plan. If they die 2 weeks into their savings plan, Kenny, their money
time to
never
grow.
had time to grow. So while you're building net worth, Akira, you first must ensure your net worth. Let me explain. Let me ask you this, ladies first. Akira, 10 seconds or less. If someone said to you, Akira, what is your definition of life insurance? What would your response be?
If I die, he gets money.
That's pretty good. You got pretty simple, pretty simple, pretty simple. Now, Kenny, what would your definition be? You can't say same thing. So what would your definition be if someone said, Kenny, define for me the subject of life insurance? What would you say?
I think income protection.
Income protection? Okay. Tell me if you both agree with this statement. Life insurance is actually death insurance. It is the creation of an instant estate based on the premature death of the breadwinner. Is that a fair statement?
Mhm.
Okay.
Okay. There's two kinds of life insurance, Akira. One of the types is called cash value life insurance, and the other type, Kenny, is called term. Now, one of the biggest mistakes people make, Akira, on the subject of life insurance is they actually treat life insurance as an investment, which is a major mistake, Kenny. Here's what I mean. This is an example of how cash value life insurance works, Akira. You have a husband and wife, call them John and Mary. Let's say they get a life insurance policy 20 years ago, 1996. Here we are 20 years later, 2016, okay? Each of these husband and wife have $150,000 of coverage. Akira, they're putting out $298 a month in terms of premiums, which seems kind of high, but not all those premium dollars can go to just purely life insurance. Some of that money goes to an investment, see? Investments.
Yep.
So if you break it down roughly, say $98 would go pay for the life insurance, and about $200 a month, Akira, would go to an investment that grows inside the policy over time. Now, watch. Let's say 20 years into this policy, Akira, this guy, John, dies. His wife, assuming she's the beneficiary, right? I could tell you some crazy stories about beneficiaries, right? Assuming she's a beneficiary, she's going to get a check for $150,000. Now, you also have, remember the investment, Akira, building inside the policy?
Yep.
So let's say you've accumulated about $1,000 a year for, say, Kenny, 20 years. So you've got $20,000 accumulated in this cash value policy in a quote-unquote investment. So you've got the $150,000 of life insurance, you've got a $20,000 investment in addition to the life insurance, okay? Now, if that guy, John, dies, Mary's going to get $150,000. Akira, where does the $20,000 investment go?
Goes to Mary.
That's what most people think. Kenny, do you know where the $20,000 of savings would
I
go?
would assume it goes to Mary too.
Yeah. Most people think that the fact is the insurance company keeps all your savings.
Wow.
How do you think that makes people feel?
Angry.
Pretty angry.
Pissed off.
You got it. Now, not only do they lose their cash, let's say, Akira, they don't die and they're perfectly healthy. Let's say they've got $20,000 in their savings. They want to take out, say, $10,000. They want to put maybe a pool in. They want to buy half a car, something like that, okay? They take their money out, so you call up New York Knife. They're really called New York Life. I'll call them New York Knife for reasons I'm about to explain, okay? So you call New York Knife and say, listen, this is Akira, and I would like to take out $10,000 out of my cash value life insurance policy. And they say, no problem, Akira, we can send you $10,000, but whenever you take money out of your policy, you have to take it out, Kenny, in the form of a loan. And when you borrow money from an institution in the form of a loan, you have to pay it back with principal plus what?
Interest.
How do you think people feel about paying interest on their own money?
Not happy.
Not good at all, right? Plus, Akira, the money that you borrow out, not only do you have to pay interest, it's also a dollar for dollar deduction off the death benefit. So if you take out $10,000, you now have $140,000 of coverage, but Kenny, you're not paying $298 anymore, you're paying more like $350 because they're charging interest on the money you took out. So the net effect is you're paying more premium for less insurance, and you're, Akira, being ripped off and you don't even know it. This is where people typically get infuriated. And they want to call their agent and say, what is going on? And I'm more than happy to sit down with you and your former agent with a tape recorder, and we can discuss your policy if you would like. That's completely up to you. We believe in something, Akira, called buy term and invested difference. Let me explain. So, Akira, if you asked this woman, Mary, if something happened to her husband, John, you asked her, would you be better off with $150,000 or $300,000? What do you suppose Mary would say?
300,000.
How long would it take her to make that decision?
Less than a millisecond.
What would you think of her if she said 150 was better?
She's not smart.
Okay. Now, Kenny, was that a difficult question?
No, it was not.
Could you see yourself asking somebody that question?
Yeah.
Did I try to sell the person anything?
No, you didn't.
You can see how I helped the person.
Yep.
Okay, now most women, Akira, by the way, would rather have their husband, but there's a select 10% women would rather have 300,000. But anyway, she's not laughing that much. I can see. But at any rate, then we asked the husband, if something happened to your wife, would you be better off with 150,000 or 300,000? The answer is obvious, 300,000. And now we even put a little bit of coverage, Akira, on children. Now when I first started the business, I didn't put a lot of coverage on children, but unfortunately, sometimes things do happen to children. So we put a little bit of coverage on kids, in this case, 25,000. So here the total coverage was 300,000. Here they're paying $298 a month. Here we more than doubled the coverage, 625,000, paying $123 a month. Kenny, we just saved them $175 per month. Now, they can Akira do with that money whatever they want to do. It's their savings.
Right.
We suggest investing it. You don't have to. You can do whatever you want to do with it. But can you see how we're finding money for people to save?
Yeah.
So now, Akira, if you put that 75, and by the way, the 123 is locked in for 35 years. So if you take that $175 and you invest it for 35 years, and keep in mind, they spent no new money.
Okay.
We just bought term insurance and invested the difference. They take that $175 a month at 9% for 35 years. Akira, you've got $518,000 over a 35-year period. And now they're what they call, Kenny, self-insured. Because Akira, if they've got $518,000 cash money, do they really need $300,000 of life insurance anymore?
No.
Because they're self-insured. Now, if this is program A and this is program B, and you ask the person, Akira, what is more beneficial to your family, program A or program B, what do you suppose they'd say?
Return B.
How long would it take them to make that decision?
In less than a millisecond.
Do you think you can say it to somebody, Ken, and you can teach them how to do the exact same thing I just taught you?
Absolutely.
Pretty simple stuff, right? All right, let me wind down here. Our whole business philosophy, Akira, ties into something called the theory of decreasing responsibility. Let me explain. Gold line, Kenny, represents money, cash, assets, okay? Green line represents a person's financial obligations or their insurance needs, okay? So when people are in their 20s, Akira, 30s and 40s, and the closer to 50 I get, the younger 50 looks, right? I'll be 50 next year, right? You typically have young kids, you have a debt, and you got a mortgage. So your need for insurance is high, your assets are low. However, as time goes on, as your money and your cash and your assets, Kenny, are increasing, your need for insurance is what?
Decreasing.
That's exactly right. Can you see how the word decreasing just fell out of your mouth?
Mhm.
Because you both understand what I'm saying. Because now, at retirement, your kids are grown and out of the house, hopefully out of the house, right? Except my 27-year-old son is still living in my basement. I'm venting here for a minute, guys, so keep praying for me, right? So your kids are growing out of the house, hopefully out of the house. You have lower debts, and your mortgage is paid off. Give an example, Kira. I'm 49 years old. My wife carries $800,000 of coverage on me. I carry $970 million on her. Just kidding, right? I carry about $600,000 on her. But we also have investments going, IRAs, building a business, and things like that. So Akira, 20 years from now, say I'm worth $1 million, $2 million, whatever my wife and I are worth, we don't need the insurance anymore because we're self-insured. Does that make sense?
Yes.
Okay, let me wrap up here. Akira, people don't plan to fail. They simply fail to plan. Let me explain. If this is you have your average consumer, Kenny. They've got some installment loans. It's like maybe, like say, a car loan, maybe a school loan, credit cards, mortgage payment, or rent payment, depending on their living arrangements, okay? They've got cell phone bills. They've got gasoline for their car, food for their house, Xbox One games, all the expenses in life, right? Absolutely, right? When a person pays all their bills at the end of the month, Akira, what's left to invest for most people?
Nothing.
Nothing. Would you both agree that's a problem?
That's a
Right.
problem.
Okay. Now, the solution we have, Kenny, is something we call a financial needs analysis. We call it an FNA, financial needs analysis. What this is a complimentary, doesn't cost either one of you one penny. It's confidential, and it's a customized program that help you achieve your goals and your dreams. Covers 4 areas, Kenny. Helps people out with their savings, debt solutions, income protection, income management. Now, question for both of you. On a scale of 1 to 10, 10 being the highest, how would you rate your own personal desire to become properly protected, debt-free, and financially independent? What do you think?
10.
Everybody says 10. And then, Akira, when I ask people in reality, how would they rate their current situation? What do you think they'd say?
4.
1,
2, 4,
Well.
1. Not where they want to be, correct?
Correct.
So here's where they are financially. Here's where they want to be. All our business does is show a person how to bridge that gap. And most of the time, Kenny, the thing that needs to bridge the gap is extra income. Okay? Let me wrap up with 2 last things. Here's how most people, they're trained to live their life this way, Akira. You're in school right now.
Mhm.
So when you graduate, you want to go get a job. Is that correct?
Correct.
Okay. So you go get a job, and you're excited when you get a new job, and that your honeymoon stage usually lasts for about 3 to 6 months, and here's what starts happening. Your life starts evolving around your job, and you almost feel trapped. And what you start doing is you start chasing your paycheck, which brings with it a lot of pressure. And many people face lots of problems. What I'm suggesting is you get your life back, develop a business that you could get excited about in terms of helping people, and have your business evolve around your life, and you get free. And that's a simple decision. And the last thing I want to share with you, one of the things that I'm very excited about, Forbes magazine did a whole article on us back last August as Primerica, one of the most 50 trustworthy companies in the United States of America. Plus, we've got the most respected financial companies that are actually chosen to partner with us to help get middle-income America back on the street financially. Does that all make sense?
Yep.
Makes sense.
Let me end with this. If Ted and I could come back with a financial plan, Akira and Kenny, we come back with a financial plan that's better for you in every way, you be the sole judge. Is there any reason we couldn't do business if you were happy with it and it made total sense?
No.
Any reason? Any reason? Okay. Secondly, we'd ask that you recommend 10 people, exactly like yourself, who ought to hear about our company, our concepts, and our expansions plans, just like Ted did with you, Kenny. And those people, Kira, make up their own mind. Is that fair enough?
Fair enough.
Okay. Final thing is this. We have a short little questionnaire I want to go through right with you, which is called a financial input sheet. It's kind of help us help you. I'm going to put this together, but can you both make yourself available next Tuesday evening at 7 o'clock? You have anything on the schedule right now that you know
Well,
of?
if we do, we can take it off.
Okay, reason I mention it, our company is doing a business briefing where we are going to be talking a lot more in detail about what our opportunity is about. You'll meet some great people out at the office, and you'll get a lot more detailed information as far as how we do what we do, why we do what we do, our compensation plan or benefits, whole 9 yards. As a matter of fact, I can arrange for Ted here to come pick you up. He'll bring you out to the office, and I'm pretty excited about working with you guys. You guys are very coachable, and the future's extremely, extremely bright. So let me go ahead and get started on this financial input sheet, and we'll take it from there. Fair enough?
Fair enough.
This concludes the presentation. Good deal. Give these guys a hand. Good job.